some of the more infamous Ponzi schemes. Charles Ponzi, who is not by chance the last name Ponzi, that's what Ponzi schemes were named after in 1920. The quick background on that one, and it's a lot of words, so I had to write it out here, but he said that he was profiting from arbitrage trading on international postage reply coupons. And yeah, so that was now this was an example of where there was no operation. He wasn't doing it was a complete Ponzi scheme, not a Ponzi like scheme. There was nothing going on behind the scenes, but he ended up accumulating $15 million in investments, which in today's dollars is 200 millions, which would be a pretty sizable Ponzi scheme. And he did that in just 8 months. He was convicted of mail fraud, which we'll go into detail in the legal in a few slides here when we get to the legal point here about the different ways that in criminal matters, it doesn't just say Ponzi as the criminal count. It's mail fraud, wire fraud, money laundering, securities fraud. Those are what the counts actually say. And it's the mechanism of how money that was brought in deceitfully was, was orchestrated or pushed through. Um, he served prison time and was deported as well. Bernie Madoff, obviously, everybody's at least familiar with the name there. There were several back in the early 2008s that, or 2008 9, that were things probably with the financial crisis started to come office. But Bernie Madoff, he touted that he had a sophisticated investment strategy involving a quote split strike conversion technique. He that is actually a real technique. He didn't coin it, but he wasn't actually doing that. So he was lying about how his investments were even going here. About $65 million investments, 17 billion in investor principal was at loss. And we say it is, there are actually some good websites. I don't even know if the 94% is necessarily accurate as we stand here today, but they've recovered about 94% of the principal losses on that matter, which is kind of hard to believe. But this triple asterisk is there for a reason. It's very deceptive in this world because a lot of recovery, most of it actually comes from recovering from prior investors' profits, and profits from the SEC is in a net cash basis. So if you invested $1 million over 20 years, you made $4 million, you profited $3 million, and you can be sued for that $3 million, regardless if that's 10 years old and you've been living off of it, you can be sued for that. We'll talk more about that, but that's where this 94% came from for the most part.
Yeah, so the claims procedure with the Madoff case, I looked it up earlier today in terms of what they've collected. It looks like they've collected as of February 28, 2025, which is the most recent reporting, they've recovered $14.739 billion. So I think that 94% may be a little bit off, but 14.739 is crazy high for a Ponzi scheme. It's more common to see recoveries of 5 to 10, maybe 15 cents on the dollar. So what the trustee and his counsel have been able to do in Madoff is nothing short of miraculous. The claims procedure in that case, and in all of these cases, whether it's in the bankruptcy or the civil context, there will be some type of claims procedure that's established where folks who believe they were wrong, whether they invested or whether they did business or whatever the case may be, if they felt like this defendant owed money, then there's going to be a process where you have to submit a formal claim saying, under penalty of perjury, I believe I'm owed X. In the Madoff case, the claims procedure the trustee came up with, and Cliff touched on it, is a net equity method, where he determines that he would calculate a customer's net equity based on what real assets were put in versus what money was taken out, if any. So in that case, it's a cash in, cash out method, like Cliff said. But in other words, investors who withdrew at least their initial investment, you invested 2 million, you withdrew 2 million out, you do not have a claim in the case. That claim is barred. And of course, these folks were upset by this decision and started objecting tooth and nail, and making the argument that, look, we've we've based our lives, we planned our lives on these reports showing that our investment had actually grown. So yes, I put in $2 million and I took out $2 million, but if you look at all these statements that they were providing us monthly, it shows that I've made way more money in terms of returns. Kind of a nonsensical argument considering the whole backdrop is a fraud, which is what the trustee pointed out in his response. So ultimately, these what are called net winners, the ones who didn't lose any money out of pocket, they appealed this claims process all the way to the Supreme Court, which ended up declining to hear the case, making the claims procedure final. And so now those folks do not have claims in the case. So it's a little bit in terms of the percentage of claims being paid. Some of those folks don't have claims because they came out even.
Yep. Very good. Yeah, I think that I remember looking at the website. Josh had sent me a website that shows the tracker. There was one person that they had recovered $5 billion from. Hope he had a lot of money on the side, more than that. But so real quick on these, the Allen Stanford, kind of more important because this was a Northern District of Texas, which is where Josh and I think a lot of people on the call reside. Another 2009 one. He was selling high yielding CDs through his Antigua, the country based bank that was actually in his name on it. He claimed that they were backed by a diversified portfolio of marketable securities, but in reality, he was misusing them and putting them to risky ventures and things like that. So, that's the argument of representations of how the money was actually being used versus, what he was trying to do, and just kept failing at it. But they had $7 billion of defrauded investor money there. And on this one here, it says, due to complex offshore assets, they recovered less than 5%. We're going to get in a few slides about what's sort of typical on it. Tom Petters is another famous one. Again, 2008, bad year for these, where he was selling financing for the purchase of consumer electronics and then selling them to big name stores like Costco and so on. But really, he wasn't doing that. That was just what he was saying he was doing. And the transactions were just fabricated when people were asking about them. But what was unique on this one here with Tom Petters is that his company had actually purchased the company Polaroid, so the famous photography company, and I think it was like 400 million or so that they had bought it for. And then at the end, when this all went down, the receiver was able to sell Polaroid for $600 million. So at least he did one thing right, and that got some money back to the underlying investors as recovery.